could the tanks run dry? And in their view, in my view, they sure could. And that's just not being factored into the current price of oil. How can you have this tech boom without energy? I mean, tech is very energy intensive, and nothing is more energy intensive than these data centers.
What does this intense concentration around the world, not just in the US, tell you about investing in 2026? I'm pleased to welcome back to the show David Hay, former CIO of Evergreen Gavekal and author of Haymaker Publications. We'll be getting his take on how the Iran conflict and the closure of the Strait of Hormuz has impacted markets and what's next for investors. Welcome back to the show, David. Good to see you.
Thanks, David. Always an honor and a privilege to join you. Congratulations on how well your show is doing, as usual.
Privilege is all mine. Thank you very much for coming back on the show. It's good to see you're doing well and your publication is doing well. Everybody should check out Haymaker Publications, link down below. David, let me just start by talking about the allocation of capital right now and how you would prioritize that for your portfolio. And I know we've talked about treasuries before. At some point, you've liked treasuries. Nobody I've talked to currently has liked treasuries. In fact, most people have abandoned the 60-40 to go into something else for alternatives. Is the 60-40 still relevant for you, given how far yields have risen? And by the way, the 30-year yield, I believe, is at a 19-year high.
Yes, you're right. And we've been negative, as you know, on long-term treasuries for actually years, going all the way back to the summer of 2020 when the 10-year treasury note got down to a yield of like 55 basis points, almost a 0.5%, which seemed insane to us. You're raising a good point. I think that now we've got the 10-year at about a 450. It hit almost 470 a week or two ago. The 30 years at 5. So it's definitely more tempting. And I do think that for a dexterous trader, you could do, a buy, put on some treasuries, long treasuries, kind of as a hedge against what seems like an awful lot of euphoria and a stock market that doesn't look good on a number of measures. Now, maybe it's just going to be another one of our little temporary corrections, but if there is a sharp sell-off in the market, you could get a nice rally on treasuries. I think those rallies are to be sold. So I think anybody that buys a 30-year at 5% should realize it's a tactical trade, not something you could buy and put away for years and years and years, unlike, say, in the early 80s when you could. So I think that you're right. I think there is some appeal there. We tend to prefer emerging market debt still because you can get so much higher yields, and I think you've got a much more positive fundamental backdrop. And if you look at the last 3 or 4 years, those bond markets are making new highs while the developed bond markets are making new lows in price, which means new highs in yield. I mean, this is a yield breakout in almost all the developed worlds, as you know. So it's a continuation of what has been a multi-year global bond bear market for the rich countries, so-called rich countries.
Stock markets are taking a huge hit today on the 5th of June. Now, some of this has to do with the Broadcom sell-off that's pulling down the entire tech sector. The S&P is down 2.5%. The NASDAQ is down 3.7%. But gold is down 3.5%, and Bitcoin is down 6%. It looks like profit taking across all sectors right now. What's going on, you think?
Well, Bitcoin is, it's down over 50% now. It's getting slaughtered. And Ethereum is even worse. I mean, to me, it almost feels like we got a little bit of a global deleveraging cycle going on out of the blue. And we've had these periodically over the last few years. The Liberation Day and then earlier this year with the war in Iran. So, you get these periods where people kind of panic and they just sell everything. And so I think that's why you're seeing, the kind of this unified decline. We've been warning, particularly in the last couple of weeks, that the U.S. stock market was looking a little precarious, at least on a near-term basis, with very poor breadth. The VIX was actually going up while the stock market was going up, which was very unusual. On the breadth topic, you had only about 5% of the S&P stocks making new highs as the S&P itself was making new highs. That's really narrow breadth. Then you've got, of course, this tremendous amount of money that's going to get sucked into these new IPOs this summer, 4.5 trillion. Now it's all into the market at once. And I'm talking about SpaceX and Anthropic, and there's about 4 others that are going to suck in trillions. I mean, we've never seen it. If you look at the whole history, we're going to go down that rabbit hole a little bit. The whole history of the U.S. stock market, going all the way back to 1792, there's only been 1.5 trillion of IPOs cumulatively. And we're going to do 4.6, actually, I think is the number this summer. Again, it's not all going to hit the market at once because, as you're aware, there's lockups, so the insiders can't sell all at once. Although they're making it easier for them to, they're going to be able to sell it quicker than they normally can, or their lockups will be shorter. And then you got vesting schedules for the employees and so forth. But still, there's going to be a tremendous amount of money pulled into those names, and it's got to come from somewhere.
Would you buy these IPOs, by the way? So there's,
No.
okay, no, clear answer. So I've heard that several people have told me this. If you buy this IPO, your exit liquidity for the venture capitalists, you already got it, so you're not early. And these valuations of some of these companies, SpaceX, for example, 100 times earnings, I think, something like that. Very, very ridiculous are some of the comments. But then I think to myself, okay, when Tesla IPO'd, they were pre-revenue. Sorry, not pre-revenue, pre-profitability. They weren't even making, they weren't even making money. Yet, if you had missed out on that IPO, you would have missed out on one of the biggest gains in tech history. So I don't know anymore.
Well, I think that's a good comment. I think we all don't know anymore because this has been such an unparalleled period that we've been going through where valuations are just like, man, there just seems to be no ceiling. But of course, so here's a good example. When Google went public back in 2004, I believe it was right around there, its total valuation, including all the locked up shares, was 23 billion. And if you went back and looked at Tesla, probably somewhere in that area. So my point is those things were starting with much, much lower valuations. That's why when you look cumulatively, going all the way back to 1792, there's only been 1.5 trillion of IPOs because they started at much lower valuations. Then if they were a winner, then they exploded. But here we're starting out with enormous valuations. So the margin of error is very skinny.
Before we continue with the video, I like to address one of the fundamental problems of owning gold. Now, gold is seen in most cases as a store of value, but it has one major problem. It doesn't generate a yield in itself. And that's where today's sponsor, Monetary Metals, comes in. Monetary Metals introduces a model where gold can produce a yield paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces. That means your returns are measured in gold itself, not just in fiat currency terms. In an environment where many assets depend on price appreciation alone, this approach allows gold to serve both as a store of value and as a source of income. The metal remains your asset and can be redeemed at any time. Thousands of investors are already earning a yield on their gold through Monetary Metals, so visit their website today to get started and learn more. That's monetary-metals.com/Lin. Link in the description down below or scan the QR code here and get your gold to start working for you now. What do you think has changed for the markets permanently, if anything, following the start of the Iran war? Now, you have a slide deck entitled Crude Awakening. Now, crude has awakened. What are we in for a crude awakening for the rest of us?
David, this is our usual David Square thing, my little joke about our common names.
Nice.
And as you said, crude awakening. So it's a play, of course, on the old phrase rude awakening. And the point of this chart is that, let's just see that the markets don't seem to care at all about this Iran war. Here's the XLE, the leading energy ETF since the war started back on February 27th. It's up a little bit, hardly at all. It ran up decently to begin with, but it's given most of that back. So there isn't, a sense of unease, at least bullishness on energy. And I think that's just really bizarre given the fact that this is the most severe energy crisis we've ever had. Going back to the 1970s when we had what everybody thought was an energy crisis that would never be surpassed, we've lost at least 1 billion barrels of output. And it's likely headed to 1.5 billion. As you know, there was a lot of enthusiasm about peace last week, and yet, the Iranians are attacking Kuwait and Bahrain, and I mean, it doesn't look like this conflict is at all at an end. So it's a major supply shock, and I think the big misconception is how quickly things can return to normal because we're drawing down inventories throughout the whole global system, not just the SPRs, but the floating storage, pipelines are being drained down and tanks are getting low. We'll talk about that a little bit. So we're really looking at something that we've never seen before, as I said, even in the 1970s. And there's a belief that before the war there was a huge glut of oil, but that was really because the IEA International Energy Agency consistently underestimated demand, and they increased right before the war by 1 million barrels a day. which is a big number. According to their calculations, there's some 830 million barrels of oil that's missing. And that's their fudge factor. And they've been wrong just over the years. I mean, over the decades, really. And actually, Mike Rothman at Cornerstone Analytics has been in a battle with them for that length of time, and he gets kudos for being right. They've been wrong. So basically, we've got a situation where 13 to 15% of global supply is offline. It's trapped in the Persian Gulf. That's just enormous. I mean, a million barrels a day, 2 million barrels a day in the past was considered to be a huge supply deficit. So, as I said, this is worse than 2022 when Russia invaded Ukraine. There really wasn't much of a supply cutoff at all. The 1990s and even 1970s. So, 1990 was when Kuwait was invaded by Saddam Hussein. Okay, so let's forget what people like me are saying. How about the real pros, like the senior management at Exxon? We're approaching unheard of inventory levels, unheard of. And this is, I think, a very key point. The drawdown will persist in the weeks ahead, regardless of diplomatic progress, just because there now is such a shortage that's been built up over these last 3 months, over 3 months. And basically, the CEO of Chevron, Mike Wirth, is saying pretty much the same thing. The buffers are out. Now, I think, have you ever had Adam Rosenzweig on your show, by the way, from
Who?
Gehring and
Sorry.
Rosenzweig? Have you ever had Adam Rosenzweig on your show from Gehring and Rosenzweig?
Oh, I have not. No, no.
He'd be a great guest. He's very
Okay,
articulate, very smart.
I'll keep
And
that
they
in
put
mind.
out your viewers can go to their website and get their free research, and they just put out a 44 pager. And I know they're not going to read all 44 pages, but they can scan through. There's some amazing charts. I'm going to recreate a few. It's a great read, and their point was very similar to what I just quoted from Exxon and Chevron. Could the tanks run dry? And in their view, in my view, they sure could. And that's just not being factored into the current price of oil. They're thinking that we're looking at sustained oil prices of 120 to 150. That is such a radically different view than the consensus. Now, obviously, they can be wrong, but let's think about why they could be right, because the market obviously has been priced for perfection and beyond. So they talk about the complacency that I mentioned earlier, and we can see that when we get to the term structure of the futures market. But they believe, just like Mike Rothman at Cornerstone, that demand has been running much stronger than popularly believed, 105 to 107. In fact, I just saw that Cornerstone is saying they think it could be at 109 million barrels a day this year, despite the war. Now, there's a problem with that. And of course, now here's a great example of the tank running dry with the U.S. Strategic Petroleum Reserve. So what we see, it's collapsing because they're selling so much out of it. And unfortunately, back after Ukraine, there was a big SPR release. Now, some people thought it was politically motivated because even when it became clear that there wasn't going to be a supply shock after the invasion, they continued to dump oil out of the SPR. It turned out to be a very poor move, but they did it. So Rothman's sinking 170 to 180 on oil. I think, well, here's the point I was trying to make. If you look right below that underlined section, the December 26 futures contract is only pricing oil at 80. And that's very, very cheap when we look at it on a real inflation adjusted basis. And that's basically what this visual shows. So it shows us here, it's really just midpoint. This is going way back to the mid 70s. So there's really no premium in there for this being the worst energy shock ever. I find that rather astounding. And I think it creates a great opportunity.
170 to $180 barrels. Now, what does that do to the economy? What does that do to the markets? At even $100 a barrel, we didn't see the stock markets crater like some people might have expected initially. And yet we're at all-time highs, barring today's sell-off. So I wonder if 170 is just going to be another drop in the bucket for investors who are more concerned with AI tech earnings than what's happening in the Middle East.
Well, there's a connection. I mean, it's great that you bring that point up, and I'm going to talk about that a little bit later if we get to the slides. That how are you going to power these AI data centers? I don't know if you've seen this, but roughly half of all the AI data centers that have been announced are being either deferred or canceled. And it's not because of lack of chips, it's because of lack of energy and also, populist pushback because they don't like what we'll see. We've got a chart coming up of electricity prices, which are starting to look like a tech stock in the way they're going up. So the solution is to have more energy. Now, so this isn't really happening at a very convenient time to have this tremendous supply shortage. Now, fortunately, those data centers are to be powered by natural gas, not oil. and natural gas has stayed remarkably cheap. And that's where I think you've got, I mean, really, I'm more bullish on natural gas long term than I am even on oil because of the, well, I mean, there's just tremendous demand drivers. You want to skip to gas and look at that?
Yeah, let's do that. But before that, I have one more question on the broad market.
Go
So,
ahead.
one of the shifts that happened as a result of higher oil prices is stickier inflation expectations. We saw the long end of the yield curve go up. But on top of that, expectations for a Fed hike have risen dramatically from basically 0 to now 30% by year end. And so the question is, why are markets not yet, or perhaps they are, why are equity markets in particular not yet pricing in the chances of a hike? Last time this happened in 2022 when the Fed hiked, stocks really didn't like that. Yet, again, all-time highs.
Well, I just think there's so much momentum, so much money that's coming into the market that, but you add up these things and that's certainly a negative. And the oil price surge that we've had is a negative, and particularly if it continues to go higher, that's a negative. And, we talked about this tremendous amount of supply that's coming from these IPOs. I mean, at some point, you get enough straws that it breaks the camel's back. But, one on its own, I don't think just the Fed hiking one time would be, that deleterious to the market. So I think that's kind of a sideshow, to be honest with you. I think what's happening in the energy world way outweighs the Fed, though it could cause the Fed to tighten a lot more than one time if they really feel like this energy crisis is here to stay. And that's why I think this is such an underappreciated aspect. And I guess before we go to gas, I just want to point out this chart again from Cornerstone Mike Rothman. And if we're now in basically week 13 going to 14 of the shutdown, and what you can see this, if you look at this far right column toward the bottom, this is basically 1 billion barrels that we've lost. And it looks like it's headed to 1.5 billion. And again, at some point, the market can kind of ignore these things for a while, but at some point, reality bites and bank bites hard. That just shows what I was saying earlier about $80 is the projected price by December. What's interesting too is we're not getting demand destruction yet. Flight data continues to be quite strong. And that's really what's going to happen, David, is because the shortage is so acute, you're going to have a major price spike so that you do get demand destruction until the supply can come back online. But the problem is, this is from Morgan Downey's, wrote the book Oil 101. Global demand has only contracted year over year 4 times in the last 160 years. One of those, of course, was during COVID, when the global economy is basically shut down. So I won't belabor that. I already made that point. The Permian is trending down in production. That's huge because that's been the main source of U.S. shale growth, and U.S. shale growth has been almost all of the global supply growth. Then we had a collapse here in oil inventories. But what I really want to do is get to the well, this is a positive. This is something that should be noted, which is the global economy is much less oil intensive than it used to be. So that's the positive. I think the flip side of that is the developing world, of course, it gets more affluent and they obviously use more energy. So you're still seeing the demand for energy going up. But let's go to gas, hitting the gas. So we talked about this already, these data centers. So I don't know if you know these numbers. They're pretty staggering if you really drill down. So these are the ones that are under construction right now. It's going to require 37 gigawatts of electricity. Now, to put that in perspective, each one of those is equivalent to a large-scale nuclear plant. It's an enormous amount of energy needed. And then another 146 were the ones that are under firm commitment. Now, again, I think a lot of those under firm commitment are going to get canceled because there's just not going to be enough energy for them. But it is a staggering amount, even just, if you cut that in half and say, well, 90 of these will get eventually built, or, it's going to require 90 gigawatts. Here's what's happened. Talked about this a moment ago. What's happening to electricity prices? They're starting to go postal. That's not very popular with the voting public. So nukes, a lot of talk about nukes being fast-tracked, and I'm a big believer in nuclear energy, and there is a renaissance going on. I'm an investor in a couple of these smaller microreactor companies. But really, for the next few years, gas is the only viable solution, and it's cheap. So what this shows is the discount of U.S. gas to the global market. And it's now those are LNG prices in either Asia, that Platts is Japan, Dutch TTF is Europe. But you're talking 16, $20 per MMBTU, which is loosely equivalent to a gallon of gas. It's actually like 1/6. There's about 1/6 as much energy in a gallon of gas as there is in an MMBTU. I'm sorry, the other way around. It's 6 times more energy in a gallon of gas But the point is that our gas prices are deeply, deeply discounted. As Gary and Rosenzweig says, it's a 90% discount. U.S. gas is 90% discount to international prices. That's
Yeah.
just not going to, that's just way too big an arbitrage.
Hmm.
And then you look at, how are people positioned? Are they overly excited about it? No, no. Look at this is the red line shows that actually you've got bearish positioning in U.S. natural gas. And then if you look at Europe, I don't know if you're aware of this, David, but you probably are because you study these pretty closely. But unlike after Ukraine, where Europe built up a big gas storage amount, they've let their storage go down and down and down. They've been way too complacent. And then we've got we talked about this a little bit with Qatar. 20% of global LNG is now offline. Gets very little press, and these facilities have been severely damaged, so they're likely to be offline for an extensive period of time. So, you think about, okay, there's not enough LNG in Europe and Asia, so they're going to have to take more U.S. LNG. There's a number of U.S. LNG export facilities, gasification facilities under construction. So that's going to be a huge demand for natural gas. Then you got the data centers, and you got gas still trading in the threes. I think people are going to look back and say, what was I thinking? How did I not load up on natural gas at that point?
So is the assumption here that petroleum will stay high because of what's going on? And if so, people will flock to alternatives to Brent and WTI, such as natural gas and perhaps down the line uranium?
Well, I think the bullish gas story is really independent of what's going on with oil. I mean,
I see.
obviously there's a relationship, but I think where the really direct relationship is this slide here. We've talked about it. Look at where Qatar is on there, number two. They're gone. That's gigantic. So now it's really all on the shoulders of the U.S. to make up for the drop off in LNG exports that was expected from Qatar. Now, the other thing which I want to talk about briefly is coal. And I've been reluctant to be a buyer of coal in the past because it's just so dirty, so polluting. And it's not CO2, it's all the, nasty stuff, the NOx and, nitrous oxide that is emitted by coal, burning coal. But Asia loves coal and they're cut off on LNG badly. So I think you're going to see another spike in coal prices coming up. And if we want to fast forward to that, we can. I do have a specific idea here. I guess I could stop for a second and just talk about it. If you've got your viewers want to buy natural gas producers, if they're interested, they should do their own research, of course. But
Yeah.
we like EXE, Expand Energy, a lot. It's broken out and pulled back. It's only trading for about 10 times earnings, 1.5 times sales. So very, very reasonably priced. So you're not overpaying like you are for so many other stocks these days. Same thing with Range Resources. And by the way, that's also had a breakout recently to a new all-time high, or a new multi-year high, 9 times earnings. That's what the 8.9 shows here. So these stocks are dirt cheap, just like natural gas is dirt cheap. I think you can make a lot of money on these. But as I say, coal, the Indonesia, I don't know if you saw this, Indonesia is basically saying we're not going to allow coal exports. And they're the largest coal exporter in the world. And of course, they supply Asia, China primarily. So you're going to have a coal shortage. And that's what a lot of these countries are doing. They're protecting their own domestic interests by saying we're not going to allow exports. So that's big news that doesn't seem to be reflected. Look at the price of coal. This Newcastle coal. Here's back during the Ukraine invasion, which is nothing compared to way up now. Now they got crushed after that. Now they're starting to turn back up again. So I think you're going to see a spike in that. And a good way to play that is if your people are looking for a specific idea, New Hope Mining, which is the large Australian coal miner. And to me, this chart looks terrific, like it's a coiled spring. It's only 14 times earnings despite depressed coal prices. So anyway, that's pretty much what I wanted to cover with you. That energy is just not in favor. It's just like this crisis isn't happening. These things are priced like they were, for the most part over the last few years when energy we had really no catalyst. So
Could
that's why I
it,
think there's such a great opportunity.
or could it really be just as simple as capital has been flowing into the tech companies? And just more recently, I mean, over the last week and a half, we've started to see a bit of a rotation away from tech stocks. I think yesterday on Thursday or Wednesday, I believe, for example, the NASDAQ was falling while the Dow Jones rallied 800 points in a single session. So maybe this rotation is starting to happen now. Could it just be that?
Well, I think so, but it may be a catalyst for that rotation is people kind of connecting the dots finally and saying, well, wait a second, with this, global shortfall of all forms of energy, what's going to how can you have this tech boom without energy? But tech is very energy intensive, and nothing is more energy intensive than these data centers. And as you know, that's what's been driving the memory stocks.
Yeah.
So that's what I'm saying. If there's a realization, an epiphany that we're not going to have, as let's say we're going to have half as many data centers put into place over the next few years than was assumed, a month or two ago.
Just want to share my screen for a minute. Going back to crude oil,
Well,
uh, the history of crude oil has taught us that geopolitical shocks that pushed oil higher usually did not keep oil higher. If you take a look at the invasion of Ukraine in 2022, oil climbed up, fell shortly after. In the early 90s, this was Operation Desert Storm. Huge spike came down. There was a secular bull market in oil throughout the 2000s, but it wasn't due to one particular event, I don't think. And my question is, why would this time be any different?
because the supply shock is so much more severe.
Okay.
And it's, so there's this belief. So I would admit that let's say tomorrow there is finally a lasting peace, which I'm very skeptical about. This is just this on again, off again thing that we've seen for weeks and weeks, if not months. But let's just say there is this a miracle, they sign on the dotted line, they actually, Iran sticks to their word and we quit attacking and Israel quits attacking. The belief is oil prices are going to go down, and they will initially, but then the realization is going to sink in. It's going to take a very long time to replenish these inventories that have been drawn down. And it's not just replenishing, say, the U.S. SPR. There's countries like Pakistan that never had an SPR that's saying we want an SPR. We've been running the U.S. or the global energy industry very tight,
Yeah.
just in time type of thing. The big oil companies have a lot less in their systems than they used to because they've used technology, sophisticated sensors to measure their tank volumes, their pipeline volumes, and so they've been running much leaner than in the past. But that's dangerous when you get a world that I mean, I just don't think the world's going to be the same. And mention something else, David, that worries me, and I really would be horrified if this happens. But one of the reasons that the world has coped with this is because the Saudis East-West pipeline that delivers oil away from the Persian Gulf over to the Red Sea, where it can get out without being held hostage by the Iranians. But they're pretty good at hitting pipelines with drones. What if they hit that pipeline? It's a long, very exposed pipeline. So to me, there's just been way too much optimism that things are going to return to normal in the energy complex. I think it's going to be the polar opposite of that.
What happens to the economy once we have persistently high oil, at least for the foreseeable future? Do you think actually our economy today is a little more resilient to such a supply shock and oil shock than maybe in the early 80s or late 70s? In other words, are we less dependent on oil now than
Well, I
before?
ran that slide showing the world in general is less energy intensive than it used to be. I think it's very true in the United States. Plus
Yeah.
the fact that we've gone from being, I mean, to answer your question is absolutely. We are much less energy shock sensitive than we were in the 1970s, we being the United States, because we are now mostly energy sufficient. I mean, we actually do run a shortage of 2 to 3 million barrels a day of oil, but then we have lots of natural gas liquids. And obviously we're the world's largest exporter of natural gas, which is just amazing because we used to be the largest importer. So I think the U.S. and everybody says this is nothing, no blinding bolt of brilliance here that the U.S. is pretty well insulated from this. But that doesn't mean that prices aren't going to go a lot higher, and that's going to make people not really too happy. But I think it's a matter of, yeah, we'll pay up, but we'll have supply. We're not going to have gas lines in the United States anyway. And I think other places you could have, gasoline and particularly jet fuel shortages, but I don't think this, unless we see $250 a barrel oil, I don't think this is going to cause a global recession. I think it's just painful. And for some countries, it's extremely painful. But the other issue is what's happening to fertilizers and food prices. And there's a major loss of fertilizers because of the shutdown of the Strait of Hormuz. So it goes beyond energy, but it's all related. There's a lot of energy that goes into producing agricultural products, obviously. But I do think that
Well,
there's just way too much complacency about this.
if yields are higher, does that mean we should be going to bonds as a hedge against inflation?
Well, I don't know that they're a great inflation hedge, and particularly when energy is pushing up consumer prices. But if you believe that higher interest rates along with higher energy prices are going to cause a recession, then typically bond yields come down in recessions. And I do think you're going to get these knee-jerk Pavlovian, as Jeff Gunlock calls them, Pavlovian
Yeah.
rallies when economic data looks weak. But again, I think those are trading rallies you need to sell into because the problem is that in the next recession, the government deficit is going to actually explode, and they're going to issue, enormous amounts of debt, government bonds.
Well,
So I don't think the old playbook works nearly as well as it used to.
in a period of rising yields and potentially higher inflation for longer, textbook finance would teach us to stay away from risk assets, go defensive, and start to collect yield to beat the 3.5%, whatever CPI is going to be. What should we do in that scenario?
Well, once again, I think that you have a trading opportunity with some long treasuries. I just wouldn't put
Okay.
too much there. I much prefer to be in shorter treasuries where you still can be at least roughly even with inflation, but you have the optionality of being able to, redeploy, without having to worry that, oh my gosh, we're going from 5 to 6 on the long-term treasury, which a lot of people think we will and, could have big losses. Because, you look at these price charts for these major bond markets around the world, they look sick. Now you can get oversold rallies, where the prices are too low, they rally, so the yields come down. And I think that's, as you alluded to, almost everybody's bearish. So I think it's a pretty good time to make a tactical bet like that. I just probably wouldn't put too much there.
Mm-hmm.
There is the tendency for governments when they have an energy shock like this that they, start printing money and, kind of monetizing the energy shock, which is what the U.S. did in the 1970s.
Yeah.
So it's not unprecedented.
When
It's
you
it's a tricky
see
time.
when you see WTI at $100 a barrel or close to $100 a barrel, when you see the S&P at new all-time highs, the Nasdaq at new all-time highs, gold having reached new all-time highs, silver reaching over $100 a barrel, copper at new all-time highs, the list goes on and on. How does the world fit into your bubble 3.0 thesis today?
Well, that bubble burst. So now I think you would argue that we're at bubble 4.0. So the bursting of that bubble happened in 2022.
Okay.
And it was painful with a lot of it because we really were very negative on the super high multiple stocks and the meme stocks and so forth. And those went down 78%. We're also really negative on things like Dogecoin, which got absolutely nuked and is getting nuked again. Whereas the Magnificent Seven, you can make a valuation case that these things are not that unreasonable. And I think that's probably true, at least as long as earnings hang in there. Like Nvidia, I mean, it's not a high multiple stock. It's just sales better keep coming through. So that's a different issue. Uh, so I think that where we're really seeing this speculation, I mean, the whole idea of these space stocks, I mean, it's going to be probably decades before there's really meaningful revenue and profits coming from those, or at least close to a decade. It's not going to happen overnight. And with these things, when you get so much enthusiasm, as you know, when reality sets in, the price corrections are vicious. I mean, you mentioned silver. I mean, look what happened. And we did say with people, we were really bullish on silver back in 2024, 25. And then when it went up over 100, we said this looks like a blow off top to us, and it's been crushed. And we put out a trading buy and it rallied, and we suggested selling. So we've been playing that. But these things can be, they get caught up in this speculative euphoria. They get way overdone, and then when they come down, it's just like, whoa, I had no idea it could go away so fast. And there's a lot of woes out there right now, things that are just so extended. But again, it's become increasingly narrow, which is a classic warning signal.
Anything in particular outside of some of the energy sectors you looked at and talked about that look particularly cheap to you right now? That's not overvalued. We're in a bubble.
Well, I think some of these financials that have come down really hard look pretty intriguing.
Yeah.
So that, I mean, they've been lagging the market and they did have a pretty good breakout. So a lot of times what happens when you get a multi-year breakout is there's an initial pop and then a correction and it causes people to give up on it, but it's still in an uptrend. I think that's the key thing is look at sectors that are in uptrends but have corrected. That's a pretty nice way to make money because you're not overpaying and yet the trend is your friend. They're going up. So I'd say that's one area to look at. I think China, for people who are willing to look overseas, the Chinese market had a breakout after being in a horrible long downtrend and then has corrected hard. And if there's resolution, when it's going to happen. There's going to be peace in the Middle East, and if nothing else, they're going to build pipelines so that they're no longer held hostage by Iran. But that's going to take a while. But if you're looking for a bounce back when things look better, I think China's going to have a very big bounce back. Like the FXI is a good way to play that. Not the only way, but it's one of them.
Yeah.
Easy
If you
U.S.
look around
measure
the
for that.
world, actually, also the top performing sectors or stock markets this year: Korea up more than 90%, Taiwan up more than 50%. Actually, most of Taiwan's stock market is just one stock right now. So,
Almost some I know.
yeah,
And Korea is basically two, Samsung and Hynix. And
yeah.
that's where we got lucky because we recommended Korean stocks and they even in our newsletter and they went ballistic because of those two stocks. And in fact, we actually put out one of our rare sells on the Korean stock market a little earlier this year. But I still think that one's going to get clocked at some point.
What does this intense concentration around the world, not just in the U.S., tell you about investing in 2026?
It's hazardous. I mean, that's exactly right. It's just whenever you see this kind of narrowness of leadership, it's a big warning signal.
So, for people who want to be diversified and buy the market, should that mantra fade going forward? Is that because you're no longer buying the market, you're buying a few stocks?
Well, yeah, the U.S. market now is basically not just looking at Taiwan and South Korea, but the U.S. market is about 50%, basically tech and kind of stealth tech.
Yeah.
So it's extremely concentrated. That's why I'd be looking at other areas. And to me, that's like if you want to play the tech boom, do it with energy. The other thing too and I didn't really dwell on this too much, but that I think is pretty intriguing, the fertilizer stocks, because they have done nothing. They've been really disappointing, and I think some people are giving up on them because they haven't popped. But I think that's just a matter of time before people realize that, kind of like with energy, that fertilizer is really in short supply. So a company like Nutrien, you would think, would have a nice rally coming up.
hmm Uh,
Definitely a lot of areas to make money in. I mean, there's been a lot of serious
do
corrections
you,
out there. I
do you,
think silver at some point could be good again.
so okay, let's talk about that briefly. Silver and gold stalling down from the tops early in the year. Is it coming back soon, or is it just is it done?
Yeah, it doesn't. I wouldn't say it looks like gold has hit bottom necessarily. I'm a little more leaning that silver in the upper 60s is kind of the washout point, and it got there and then rallied from like 68 to 90 really quickly. Now it's coming back down closer to the upper 60s. I think in there it's a decent value. It's I know it's hard to get excited when you saw it at $30 not that long ago per ounce, but the sentiment on these things is really negative. The open interest is extremely low and you've still got this, the sense of debasement, monetary debasement going on around the world. And of course, silver, it's got tremendous drivers from, AI. You need silver in a lot of these data centers, and of course, with the defense, I mean, every time a missile gets launched, there's a bunch of silver that's consumed, and so I think silver's got a pretty good demand story. Then with gold, of course, it's the central banks and wanting to hold that instead of treasuries. I think treasuries
Yeah.
are, I think they're a tarnished reserve asset, and I think that's a big development.
Tarnished reserve asset. What does that mean?
So the central banks don't really want to hold gold much anymore. And I'm sorry, treasuries anymore. They'd rather
Treasury.
hold gold. And I think so as the gold corrects, they're more inclined to be buying gold. And you can see that, I mean, Japan was a big seller of treasuries lately. China's been selling treasuries for years. And so they're kind of losing their preferred reserve out. I'm not saying that the dollar is going to lose its reserve currency status, but
Yeah.
treasuries are no longer very appealing to central banks. And that's a big deal. They were huge buyers for decades.
Yeah. Just on the central banks holding gold. So, as you know, foreign reserves held in gold have now exceeded foreign reserves held in US dollars or treasuries for the first time. I actually read a tweet by Mohammed Aryan that addressed this, and he said most of that had to do with just gold's revaluation upwards. So maybe for the exception of a few central banks, particularly China, we didn't actually see central banks piling into gold. It's just that their holdings balloon in value, and that makes me wonder if gold has just really become more popular as a reserve currency or asset.
I think it's both. I mean, I think it's just there's no question that there's been volume accumulation, not just because of price, but
Sure.
I can't cite a statistic to you right off the top of my head, but it's a little bit counterintuitive that because you did see a tremendous amount of central bank accumulation when gold was in the 2000s and really having its preparing for its big breakout. Uh, it's probably true that as gold went ballistic, that there was more of a backing off of the volume accumulation. but I believe they continued to buy through that period.
And then finally, do you have a preference for size? Now, I've noticed that the Russell has been outperforming the S&P year to date, 12% versus 7.5%.
Yeah, and emerging markets, which has been one of our favorites, has crushed the S&P again this year after last year too. Yeah, I think that it makes sense to kind of go down the size because you're going to get out of a lot of those bubble stocks. The one that we preferred the most is the Midcap index. I don't know if you could pull that up to show what that, but I believe that's outperforming the S&P as well.
What's the ticker for the Midcap?
Try IJH.
There we go. Yeah, that's slightly outperforming as well.
And the valuations, you got, kind of 15, 16, 17 times earnings, so pretty big discount. And so that's if you want to be in the US market, I think that's a pretty good one to overweight.
Okay, excellent. Thank you very much, David. Appreciate your
Thank you,
presentation.
David.
Yeah, where can we find your work? We want to stay up to date with your writing.
Haymaker at Substack. Pretty easy to find us there.
We'll put the link down below. Haymaker Substack, and appreciate it once again. I look forward to the next episode of David Squared. Take care for now.
I hope we get an invite back. I'd love to. And stay dry this weekend.
As always.
Okay, bye.
Thank you for watching. Don't forget to like, subscribe.